In 2023, more than 90% of the world's cross-border financial messages still moved through a single cooperative network headquartered outside Washington and Beijing. According to data cited by the Bank for International Settlements, that network processes tens of millions of payment instructions every day, quietly synchronizing banks across time zones. Yet, at the same moment, governments were spending billions not to replace money itself, but to redesign the pipes through which money moves. The paradox is subtle. The future of monetary power is not being decided by coins, tokens, or headlines, but by infrastructure few people ever see. At first glance, the debate over digital currencies appears straightforward. New technologies promise faster payments, lower costs, and broader financial inclusion. Governments want innovation without instability. Companies want clarity without constraint. It feels like a familiar policy problem, solvable through regulation and market competition. In this view, digital currencies are simply a new asset class, an upgrade to money, not a reordering of power. That logic is reasonable, but incomplete. It treats digital money as a product rather than a system. It assumes that whichever token gains popularity will matter most. What it misses is that monetary influence has always flowed less from what money is and more from how it moves. History suggests that the entities controlling settlement, clearing, standards, and compliance accumulate leverage quietly over decades until alternatives become costly and coordination becomes unavoidable. To understand why digital currency infrastructure has become a quiet battleground between the United States and China, it helps to start not with Beijing or Washington, but with a hearing room in the US Senate. In testimony reported by Reuters and the Financial Times, US, Treasury Secretary Scott Bessent urged lawmakers to pass the Digital Asset Market Clarity Act. His argument was not about speculation or price volatility, it was about architecture. Without a clear legal framework, he warned, the United States risked ceding ground to jurisdictions like Hong Kong, whose regulatory sandbox allows firms to test digital financial products under supervised conditions. In his telling, ambiguity itself had become a strategic liability. That concern reflects a deeper institutional anxiety. For decades, American financial leadership rested on a dense web of laws, standards, and private intermediaries that other countries adapted to rather than replaced. Dollar clearing, correspondent banking, and compliance norms formed an ecosystem that rewarded participation and penalized isolation. Digital currencies threaten to reconfigure that ecosystem, not abruptly, but incrementally. Think of global finance as a circulatory system. Currencies are the blood cells, visible and politically salient. Infrastructure is the network of arteries, valves, and capillaries. Change the blood and the system adapts. Change the arteries and the entire body reorganizes around new constraints. This perspective becomes clearer when we examine specific mechanisms. Digital currency infrastructure does not grow in a single leap. It accumulates through pilot programs, bilateral trials, and memoranda of understanding. A bank in Singapore testing cross-border stablecoin transfers, a regulatory sandbox in Hong Kong for tokenized deposits, a joint memorandum between two central banks to explore programmable settlement. Each initiative appears minor, even experimental, yet the repetition matters. According to BIS surveys, more than 100 central banks are now researching or testing some form of digital currency, each with its own network of banks, auditors, and technology providers. Over time, these pilots begin to entrench standards, build familiarity, and create dependencies. This is the first stage, accumulation. Infrastructure grows quietly without headlines. Technology platforms become habitual. Institutions invest in staff training, legal guidance, and compliance tooling. Over months and years, small practices become default procedures. Reduced friction becomes expectation. Expectation hardens into standard. In parallel, ambiguity in the United States slows adoption. Unlike Hong Kong, which offers a clear sandbox for experimentation, US regulations remain fragmented. Bessent's Clarity Act proposal reflects the understanding that without predictable rules, even large financial firms hesitate to build on emerging infrastructure. Uncertainty constrains not only innovation, but also participation. This is the second stage, entrenchment. The mechanisms may seem subtle, but the effects compound. Once a bank integrates a settlement protocol, all its clients and counterparties adjust around it. Once contracts reference a particular tokenized deposit system, switching becomes costly. Infrastructure, in effect, becomes leverage. Leverage does not coerce, it constrains. It shapes what is easy, what is standard, and what is expensive to change. Over decades, these constraints can recalibrate the global financial system. The logic mirrors historical precedents. The US dollar replaced sterling not through ideology, but through institutional coordination. The Federal Reserve established swap lines, the IMF codified accounting practices, and SWIFT created a messaging network. Each system initially served operational purposes, not dominance. Yet together, they structured incentives, habits, and costs. Opting out was possible in theory, but expensive in practice. Digital currencies follow a similar trajectory. Programmable settlement, tokenized deposits, and cross-border platforms are not just innovations. They are the infrastructure of influence. They automate compliance, reduce reconciliation delays, and embed practices into everyday financial routines. In this way, accumulation and entrenchment quietly set the stage for leverage. As these patterns repeat, they create structural inertia. Small, incremental choices now shape long-term outcomes in ways that are hard to reverse. China understood this distinction early. Rather than rushing to internationalize a digital yuan through open markets, Chinese authorities focused on plumbing. According to publications from the People's Bank of China and analysis by the Bank for International Settlements, the eCNY was designed first as a domestic settlement tool, integrated into existing payment platforms and government systems. The emphasis was not on replacing cash, but on embedding programmable money into tax collection, subsidies, and interbank settlement. Accumulation began at home, in controlled environments, far from global headlines. In parallel, Hong Kong emerged as a testing ground. Its sandbox regime allows banks and technology firms to experiment with tokenized deposits, stablecoins, and cross-border settlement under regulatory supervision. The territory's role is not to declare dominance, but to reduce friction. Over time, reduced friction becomes habit. Habit becomes expectation. Expectation hardens into standard. Once infrastructure is established, dependencies form. Banks, technology providers, and regulators integrate systems into existing operations. Contracts reference new settlement rails. Firms hire staff with expertise in tokenized processes. Even if usage remains limited, switching costs rise. Regulatory clarity, in this context, becomes leverage. Jurisdictions offering predictable rules attract experimentation. Over time, experimentation becomes infrastructure. This is the second stage of the system, entrenchment. Leverage emerges not through mandates, but through the convenience and inevitability of integrated systems. The third stage is consequence. Once settlement protocols, messaging standards, and tokenized networks are widely adopted, they influence trade, finance, and policy decisions subtly but structurally. According to IMF research, even small shifts in settlement preferences can alter trade invoicing patterns and bilateral flows over time. Cross-border platforms reduce dependence on traditional correspondent banking. Smaller banks gain access to networks previously dominated by large intermediaries. Sanctions enforcement becomes more complex as transactions fragment across platforms. Policymakers discover that changing rules now affects embedded systems, not isolated markets. Historical patterns illustrate this dynamic. The SWIFT network, dollar clearing, and central bank swap lines were once technical arrangements. Their long-term impact reshaped global financial hierarchies. Similarly, programmable digital currencies, even when deployed modestly, can accumulate influence over years. Efficiency gains attract marginal users. Habits solidify. Margins become leverage. Constraints cut both ways. China's tightly managed approach limits openness, slowing adoption by foreign participants. The US, reliant on private intermediaries, faces coordination challenges. Interoperability remains the largest technical hurdle for cross-border digital currencies, according to World Bank studies. Fragmentation is a real risk, but so is structural consolidation. The battleground remains quiet precisely because infrastructure accumulates power without headlines. Decisions about standards, legal definitions, and pilot programs rarely attract attention. Yet these incremental choices harden into systems that shape future options. The unresolved question is not whether digital currencies will replace existing money. It is whether the underlying infrastructure will reinforce existing hierarchies or gradually reroute them. As with previous shifts in financial plumbing, the ultimate outcome is visible only in retrospect, embedded in contracts, systems, and habitual practices long after initial experiments. Across decades, across borders, and across institutions, infrastructure silently accumulates leverage, entrenching practices, and creating constraints that shape global monetary influence. It is in these quiet mechanisms, in the flow of transactions and the architecture of networks, that the true contest for monetary power is being waged.